Hey everyone, we got some more big news for Tesla stock investors as the company announced it would be slashing 14,000 jobs or roughly 10% of its workforce. The stock price was down 4.6% as of this recording. So I'll review what these announcements could mean for Tesla stock investors and go into detail about the strategic changes at Tesla. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Here's the quote coming from Elon Musk saying that as we prepare the company for the next phase of growth, it is important to look at every aspect of our cost structure, Musk wrote in a memo. As part of this effort, we've done a review of the organization and made the tough choice to reduce our headcount by 10% globally. And there's nothing I hate more, but it must be done. Now, since Tesla has over 100,000 or roughly 140,000 workers, this means they're cutting 14,000 jobs. Stock price is down 4.7% as of this recording, but the market is down overall, with the Nasdaq index trading down 1.46%, and Tesla stock is usually more volatile than the Nasdaq. So it could be the stock price is down because the market is down rather than just because of the news, although the news was not a good sign for Tesla stock investors. Remember that these layoffs come following a disappointing first quarter delivery report that showed the company missed widely on estimates and built up supply of more than 46,000 vehicles. That means they produced 46,000 vehicles more than they delivered, implying the sales are weaker than expected. Now, Tesla's feeling the slowing EV demand worldwide. EV companies are experiencing slower than expected growth, and Tesla especially. Now, the layoffs today signals one more bad sign for Tesla stock investors in that the first quarter delivery report wasn't just a temporary thing. These are likely continuing at Tesla, which has created the necessity for job cuts. If it was a temporary thing, then Tesla would have felt like, okay, we'll ride this wave and demand will rebound and will grow forward, so we don't need to lay people off. But if you feel like your company's going to be experiencing slower growth or even negative year-over-year growth, then you feel the necessity to lay people off because you're not hopeful that demand is going to recover in the near term. So that's where this is kind of a bad sign for Tesla stock investors, in that it signals this slower growth environment is here to stay for the near term, at least until the company can launch its lower priced model, which there have been reports that suggest that it's not going to do that anymore, and it's going to focus its attention on the robo-taxi, which Tesla and Elon Musk have been promising. It's just around the corner, and they've been doing that since like around 2015, telling investors that robo-taxi is just around the corner. You're going to be able to flip a switch and your car is going to turn into a robo-taxi in a relatively short amount of time. So there's been promises of that for several years now, so don't hold your breath for that if you're a Tesla stock investor or a Tesla car owner. Now, analysts expect Tesla to deliver 50 cents in earnings per share when it reports its next quarterly results. That's down from 83 cents analysts were expecting Tesla to deliver just over 90 days ago. So the earnings per share expectations have decreased meaningfully for Tesla, dropping from 83 cents expected in the current quarter that ends March of 2024, and now it's down to just 50 cents in the current quarter. So these bad expectations are getting priced into Tesla's earnings expectations over the next quarter, and the price has repriced lower. The stock price has retraced back down. It's down 34.5% on the year so far. Still, Tesla stock is not cheap, trading at a forward price to earnings of 41.2, when most car companies are trading in valuations in the single digits, like between 5 and 9 is where most car companies are trading at. Now, before you start with the story that Tesla is a tech company, Tesla's trading at more expensive valuations than even the hottest tech companies like Nvidia, Microsoft, Apple, Alphabet, Meta Platforms, and on I could go. Tesla's trading at an even more expensive valuation than those companies. So Tesla stock is still more expensive than all of the tech companies that I just mentioned and all of the car companies that I mentioned also. So while its growth expectations are diminishing, its valuation is still expensive. Even though it's dipping down slightly, it's still expensive. And when you consider, let me share with you Tesla's performance here, its operating profit margin against some of its rivals here in Ford, General Motors, and Toyota. Tesla's operating profit margin in the latest quarter at 8.2% was below Toyota at 13.96%, above GM at 2.14%, and above Ford at negative 0.53%. But Tesla's operating profit margin is down from the peak levels of around 19% it achieved in early 2022. Arguably, that was its peak. I don't think Tesla's operating profit margin will get back to that level anytime in the next 2 to 4 years. Maybe when it develops, or if it develops the robo-taxi, the operating profit margin could bounce back up to those levels. But who knows when the robo-taxi is going to be out and available and generating actual revenue, profit, and cash flow for the company, other than just being this kind of checkpoint at some point in the future that keeps Tesla stock investors engaged and hopeful and holding on to shares, even though they might feel it's overvalued. Keep holding on because there's something next year or 2 years or 4 years later that could potentially increase its valuation. So overall, the job cuts by themselves, not really terrible. Even though, when I hear of companies making job cuts, I always argue that if you need to cut your labor force, why not do it through attrition? Let the people that want to quit, quit. Let the people that retire, retire, and just don't replace them. Although for a car company, that's harder to do because you have so many specialized employees in certain categories. So for that reason, I can understand Tesla having these job cuts because there's categories of employees here, specialties that you need. And if you have redundancies in areas where you don't feel like you need it, it's understandable to have a cost-cutting plan and have some employees be let go. Overall, on itself, I don't see these as bad signs or terrible news. It's just what it indicates, and it's something that's building this story that demand for electric vehicles is slowing, and slowing at a very rapid rate. And today, interest rates increased again as we got reports that retail sales were stronger than expected. And I've kind of downgraded my interest rate cut forecast for the year. I came into the year expecting 3 interest rate cuts from the Federal Reserve. Now I'm expecting 2, maybe just 1 interest rate cut for the year. And remember, car sales are usually financed, and so interest rates matter significantly for car sales, and interest rates are moving higher, and that makes car sales overall less attractive, and then especially for electric vehicles because they're already under pressure, and then higher interest rates are going to put even more pressure on electric vehicle sales. So the bad news is mounting here in terms of customer demand, and this is just another sign that demand is not expected to rebound anytime soon. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.